This is the Asia Trade. I'm Paul Allen in Sydney.
I'm Haidi Stroud-Watts. The top stories this hour.
Lousy job, but no, I'm not talking about that. Fortunately, we get to make a change in the next, 8 months or so. I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud.
Well, President Trump, they're throwing markets into fresh turmoil, denying a White House official's claim that he plans to fire Fed Chair Jay Powell. US stocks bounce on the denial, with Asian equities set for a mixed open.
The speculation triggering a fresh debate on Fed interference, with Wall Street CEOs emphasising the need for an independent central bank.
Plus, Canada's Couche-Tard says it's pulling its $46 billion bid for Seven & I, citing a lack of engagement with the 7-Eleven owner. And that potentially sort of diminishing of the deal prospects there, one to watch as we head into the open in the next hour in Japan. This is how futures are setting up. As I mentioned, a pretty mixed start to trading is expected here in Asia. We get further confusion, uncertainty over the future of leadership at the Fed after this ongoing skirmish that we've seen from President Trump directed at Fed Chair Powell. There seems to be some, if not a reversal, but certainly a bit more nuance in terms of his thinking there. Sydney futures, though, looking pretty robust, about 0.6% higher. We're seeing Japan looking very much like sideways trading. Of course, this sort of potential reckoning that we get as we head into Sunday's upper house elections is one of the reasons why we're seeing a lot of traders sit on the sidelines. We saw most Japanese equities falling in the previous session. Local polls at the moment indicating that we could see a loss of the majority by the ruling coalition. So there's quite a bit of political risk that's building at this point. You're seeing that kind of reflected in the yen at the moment. 147.87 is where we're sitting. Also taking a look at how we're setting up here in Sydney, as well as China futures as we head into that open in a couple of hours' time. The Sydney futures also up by about 0.6%, as I mentioned, and we are seeing perhaps just that mixed picture given the domestic US uncertainty continues to play out, Paul. Yeah,
uncertainty remaining the key word of 2025. I just want to start on oil prices here. We did see them slip a little. They're ticking up a bit now. They did edge lower on oversupply, growing stockpiles as well. But if we take a look at US equity futures, a little bit softer. It's a pretty good day for markets, though, in the US after initially slipping on all the speculation that President Trump wants to remove Jay Powell, which he later denied. We did see equities ending higher, and it was a great day for banks. Say what you like, volatility is terrific for revenue. Goldman Sachs equities trading rose 36% in the quarter. Morgan Stanley and Bank of America also have very good trading sessions as well. But in terms of the uncertainty, let's get the latest on what President Trump has been saying about Jay Powell.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job.
Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
Well, let's bring our senior editor for markets and Bloomberg opinion columnist, John Authers. And John, you know, here at Bloomberg, we've kept the receipts, right, in terms of what we've heard from the president on how he thinks about Jay Powell. Is this sort of another element of the all-pervasive kind of taco strategy of nothing is ever quite certain?
Yes, I mean, it's long been his negotiating strategy in business to keep people guessing, to keep uncertainty going, which, if you're dealing with a few other Manhattan property developers, is probably a very good idea. When you're dealing with the rest of the global economy, there are more downsides to it. What I do think is beginning to happen, though, is that it's clearer and clearer that there are fewer tight guardrails on this behavior than people had been assuming. We had the first excitement when President Trump said that he was minded to fire Powell back in April. That became one of the critical incidents of Trump chickening out that led to the taco, Trump always chickens out, meme trade. And as with tariffs, where at the moment he is continuing to say he's actually going to have tariffs at much the same level as he did in Liberation Day and then appeared to chicken out. It doesn't look as though he's chickening out on firing Jay Powell either, even if he doesn't actually fire him directly over interest rates. The kind of coordinated invective against him from lots of people in the administration, and the opening of the new front that somehow the renovations of the Fed provide a reason to fire him for cause, means it's very clear he hasn't gone away on this, and we shouldn't assume that he is going to chicken out.
Well, John, among that stream of sound bites, we did hear President Trump blaming the news media for spreading the narrative that firing Powell would be bad, and he doesn't understand why it would be bad. But all the media is doing is reporting the thoughts of the heads of the largest banks in the United States and the way markets react as well. So how have markets been reacting to this kind of rhetoric?
Well, today was an interesting control experiment in that you had a very clear story that more or less every major news organization had stood up, that Trump was planning to fire Powell after all. And that lasted for about an hour before you got the denial in the Oval Office. During that hour, you see short bond yields drop very significantly because obviously whoever gets in, the Fed is going to cut rates. You see the yield curve steepen a lot, i.e. people are very much more nervous about long yields if we're going to have this kind of less independent Fed. Stocks tanked and the dollar tanked. Once you had the new news that he wasn't necessarily firing him just yet, stocks came all the way back and finished at a high for the day. 2-year yields, however, scarcely got the memo and were almost as low by the end of the day as they had been at the worst moment of the morning sell-off. And the dollar stayed down on the day, even if it did rebound. I think that tells you, if we actually go through with the climactic event of actually firing Powell on whatever pretext before the end of his term, then you're going to see a stock market sell-off. As it stands, what we're getting is a much less independent Fed and a virtual certainty of lower rates coming down the pike, and that means a weaker dollar, come what may, and tends to mean lower short-term bond yields than we would have expected, but it also means lots of nice liquidity and stimulation for the stock market, so it keeps the stock market going nicely.
All right, Bloomberg's John Authers there. Let's bring in Chris Brigati now, CIO at SWBC. And Chris, we have heard more rhetoric, more theatre today in terms of President Trump's thoughts on the job stability of Jay Powell. Does this rhetoric, however, matter, or is it damaging to markets?
I think it does matter. It is also damaging to markets. And the reason it matters is, as John had previously stated, we kind of get a test case of how the market could react to such news. And he outlined it very well with a weaker dollar, a steeper yield curve, selling off the long end, tightening up on the front end, and overall equities disliking it. And markets dislike uncertainty. So this was a ringing endorsement for avoiding doing something so rash in terms of the market reaction. And I think, a lot of the corporate CEOs and whatnot are very adamant in maintaining the independence of the Fed. And I think that's very important for the stability and the soundness of the U.S. economy as well as the global economy.
Well, even if Jay Powell isn't fired in the near term, he will be replaced next year when his term expires anyway. What are the risks of ending up with a Fed chair that does the bidding of a political master? That's a dangerous road to go down, and I think it undermines the authority and the responsibility of making economic decisions. Once politics get involved and political decisions are being made based on influencing fiscal policy, that can lead us down a path where it's not for the long-term health of the economy. We know politicians have their own agenda. We know politicians do what they want for the reasons of their own doing and bidding. And so if something happens independent of market or economic decision-making,
ultimately that's a negative, and that's a bad thing. And I think that undermines the strength and liquidity of the U.S. dollar-denominated assets, and ultimately will lead to a sell-off in the long end of the market.
A slowdown in growth, a pickup in inflation as a result of all the tariff uncertainty, potentially stagflationary fears. We've seen business leaders like Jamie Dimon really point this out, right? But the broader markets still seem quite complacent. How do you think the next 6 months might play out? And is there too much kind of a sanguine attitude that we're seeing amongst the market at the moment when it comes to expectations of Fed easing?
You know, I think sanguine is a decent word for it. I'm a little frustrated because the markets, you know, collectively, equities and fixed income, tend to react less negatively to bad news. But once that bad news is dismissed, they suddenly rally. And we kind of even saw that today. And so I think that is not a great thing for the markets. And the markets are kind of almost dismissing a little too much at times. And ultimately, we've got, you know, high earnings in the U.S. We've got challenges to the domestic economy. And if inflation does kind of rear up its head a little bit, you know, that's a challenge. And how are we going to get through that is going to be the issue for the new Fed. If they're lowering rates as inflation is rising, we know that formula doesn't historically work.
Do you think that concern is going to continue playing out when it comes to the US dollar and also particularly on the longer end of the bond market?
100%. I think the U.S. dollar is going to continue to struggle. We were down about 10 to 11% thus far this year on the U.S. dollar, and I think that could continue. And I definitively expect the longer end of the curve to extend out further, to cheapen. And I could see us taking out the highs that we've recently had. We approached it today on the 30-year. We got within 10 basis points of the high that was established earlier this year in the 10-year. I'm sorry, in the 30-year. And the 10-year is at around a 480, and we're only 30 basis points or so away from that. So those are well within striking distance. And if tariffs and inflation continue along the path that I'm seeing, then I do expect those rates to go higher.
One thing the experience of the past few months has taught us, and Exhibit A, the big banks in the U.S., volatility is certainly good for trading. How much churn are you seeing in portfolios at the moment?
A little less churn than might be otherwise expected. I think banks and the trading market is kind of reacting a little bit more opportunistically to this. We're cautioning investors about jumping in and jumping out and kind of stay the course. You know, what is your time frame? What is your investing horizon? That has to matter for the average investor. So I think we're seeing a little less churn in portfolios than you would otherwise expect based on the volatility of the market. But as has been said, the uncertainty of the market is really a challenge. Markets dislike it. And, you know, if I was with my college friends and we were doing a drinking game on the amount of times uncertainty would be said, it would make for a very long evening.
I think you might end up needing medical care. Chris, given all of the questions and clearly hesitation you have over, you know, American exceptionalism, over American assets, are you looking elsewhere for opportunities?
Definitely. You know, I continue. I was a strongly proponent of the European equity market earlier this year, and I think we saw some of the outperformance through the first 6 months, and that was demonstrated quite soundly, especially as the domestic U.S. market was challenged. So I continue to like some things in the Eurozone. There are some issues and there are some concerns with regard to valuations there, but they're cheaper valuations than the U.S. So if you're a value investor looking for value plays, there's more value in the Eurozone than there is in the U.S. And so I think that does offer value.
On the other hand, earnings still seem pretty robust at the moment, particularly if you take a look at, obviously, the upside for banks. But what are your expectations there? And do they remain sort of fairly kind of tariff-proof for this point?
I think banks can, simply because of the yield curve. As we get a steeper yield curve, we know that that is a positive for anybody that's in the financial markets, including banks. So banks can perform well despite the tariff environment. I'm more concerned about the domestic economy with regard to manufacturing and distribution along those lines. So those things could be more negatively impacted by tariffs, and I likely expect they will be. And I do think we saw some of that data starting to leak into the market finally. It's taken a while, but we finally are seeing some of those challenges, and it's definitely going to affect prices down the road. But valuations are high. Can they go higher? Quite certainly. We've seen the story before. It's a matter of, can you stay invested long enough and continue to ride that wave? We're cautious in suggesting people do rebalancing portfolios periodically, maybe more periodically than they would have in the past, but the opportunity set is there for investors to be prudent with their investments, pare back where they've had very strong gains and rebalance and just kind of reset their portfolio.
Chris, really great to have you with us. Chris Brigati, CIO at SWBC. Coming up next on the Asia Trade, we're breaking down the shifting US curbs when it comes to advanced AI tech to China. And US Business School will be with us on that. And we'll also take a closer look at Nvidia CEO Jensen Huang's visit to Beijing.
But first, Canada's Couche-Tard accuses 7&I of a calculated campaign of delay as it abandons its year-long takeover bid. We'll have all the details of that next. This is Bloomberg.
Well, Canada's Alimentation Couche-Tard has abandoned its $46 billion bid to buy 7&I, saying the Japanese convenience store giant has refused to engage during the almost year-long pursuit. Let's bring our global business Asia editor Peter Vercoe for more. And to be fair, things had gone very quiet. We assumed that there wasn't perhaps much engagement going on. Is this sort of just closing the loop?
Yeah, this has been going on for a year. It is a little bit of a surprise because as recently as April, Couche-Tard had signed a non-disclosure agreement with 7-Eleven, that seemed to be a step towards maybe getting some due diligence done. But from Couche-Tard's statement, it seems that even from then, there's been no engagement, and Couche-Tard have laid bare a lot of detail behind the scenes of how they were trying to push this deal ahead, but really getting blocked by 7-Eleven. And so, yeah, it's been a year. 7-Eleven from the beginning have been pretty reluctant to engage in this. So, yeah, I think eventually Couche-Tard have just realised that there's not much point in pursuing this. They'd put a lot of money, a lot of time and a lot of effort into it, and it was going nowhere.
So what are the options now for both sides? I mean, is there an option for Couche-Tard to be more aggressive, and for 7&I, it put forward a plan to restructure. Is it going to go ahead with that, or is it going to show, similar enthusiasm or lack thereof?
Well, what's really interesting is Couche-Tard still say that, they see a lot of value for shareholders in combining the two companies. Given the breakdown in trust, though, it's hard to see how that could happen at least in the next couple of years. Couche-Tard have really gone into some pretty granular detail of how 7-Eleven did not want to engage. They've said that there was no sincere or constructive engagement. It was just a campaign of obfuscation and delay. So it's hard to see them coming back to the table in any meaningful way, in the near future. So yeah, that really leaves it open for 7-Eleven to push ahead with the restructuring that they've laid out. You have to sense that they're going to need to do that, because without that, what is the future for 7-Eleven, or what is the plan for the future for 7-Eleven?
And how long does that grace period from shareholders to kind of, give them time last for? Does it speak to, I guess, corporate reform and governance efforts when there's been such limited willingness to engage?
Well, I think that's really interesting because, we've seen that in Japan over the last few years, like really this big push, led by the government for an improvement in corporate governance. And this was sort of like seen as a bellwether of that. This was going to be the biggest foreign takeover of a Japanese company in history. And it was sort of seen as a real, move towards Japan opening its capital markets, opening up to foreign investors. And the whole thing's just blown up. 7-Eleven never really seemed to be interested in this. They did everything in their power to push back and not engage. So where does it leave that whole campaign? Is it just a one-off that this is a particular company that didn't want to engage, or does it say more about, the Japanese environment overall?
All right, Bloomberg Global Business Asia editor Peter Vercoe there. We have more ahead on the Asia Trade. This is Bloomberg. Sources within the White House say President Trump has softened his tone with China to secure a summit with Xi Jinping and a trade deal with Beijing. Let's bring in our chief North Asia correspondent, Stephen Engel in Hong Kong. So, Steve, what more do we know?
Well, we do know that Donald Trump wants to have some sort of summit with Xi Jinping in the not too distant future. But obviously, there are a lot of issues to be resolved with China. Yes, there's a truce going on, but that truce expires on August 12th. And there are indications that that could be extended for perhaps another 90 days. So, you know, in Trump's carrot and stick approach to trade deals, there may be a little bit more carrot than stick for Trump towards Xi and China right now as he tries to get some sort of high-profile summit with Xi Jinping and a trade deal, not just a trade truce, so a lasting trade deal with Xi Jinping. But again, Xi Jinping has been fairly quiet on this matter. Yes, Marco Rubio, the Secretary of State, did meet with the top diplomat of China, Huang on Friday, and said it was a very constructive and positive discussion with his counterpart in China. But again, there are hawks within the Trump administration who say they would want a tougher stance, much like the Trump on the campaign trail, where he was quite tough on China. And also, Trump's been quite tough on other trading partners aside from China of late, including the EU and others, including longtime allies like Japan. So there's a bit of a mixed picture coming from the White House on China. The hawks, on the one hand, would say that export controls are not negotiable, but as we saw, last week and earlier this week, when Nvidia's Jensen Huang went to Beijing with approval in his pocket for the H20, it is negotiable.
How much is a reversal when it comes to Nvidia's H20 chips a case in point that there is a softening approach towards China?
Yeah, well, that's a very interesting one, and that's why it was such an important story earlier this week. And Jensen Huang, no doubt, is in Beijing this week, and he's been talking for a long time about the importance of relaxing some of these export controls because it's putting American technology companies, and particularly chip makers, at a distinct disadvantage, according to his estimation, because it gives unfair advantages to domestic chip makers like Huawei. Well, Trump, up until recently, has been steadfast, saying we need to have these export controls. In fact, he added the H20 to the export control list back in April, only to now essentially give tacit approval for Nvidia to resell them into the China market. There hasn't been a grand statement from the White House. Perhaps that is because of the, I don't want to say rifts within the inner circle of the Trump administration, but there's definitely divergent opinions on how tough they need to be on China. I mean, it was recently, as a few weeks ago, Scott Benson was essentially saying those export controls on the H20 chip were evidence that the administration has a tough stance on China. And then this week, that all unraveled when essentially Jensen Huang and Nvidia said, we've been given approval to apply for those licenses, and we are likely to get those licenses, and we will resume shipments to China of that watered-down, specially made AI accelerator for the China market. So yes, there's a lot of competing and differing narratives coming out of Washington. But right now, according to sources within the inner circle, say Trump is trying to soften the tone towards China so he can get that summit.
Our Chief North Asia correspondent Stephen Engel there. Just breaking news when it comes to 7 & I. Those shares have been suspended as of 8:20 Japan time. This after Couche-Tard abandoning that $46 billion bid to acquire it.
Nvidia chief Jensen Huang says he hopes to get the first batch of renewed U.S. licenses soon to export H20 AI chips to China. Speaking in Beijing, he told us the now lifted U.S. ban on the chips will cost the company, but it's willing to adapt to any changes in the trading landscape.
Some of the things that we wrote off might be harder to recover, but most of the things that we put on reserve will not be scrapped permanently, was not scrapped permanently. And so we'll compare what customers would like to buy now versus the inventory that we have, and then we can figure that out. It's probably not 100%, but it's not 0% either. Tariffs. The world is reconfiguring itself, and we are a company, and we have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into Nvidia. There will be trade, tariffs, and taxes after I leave Nvidia. And so this is something we all have to adapt to. But the very incredible thing is, Nvidia is a very adaptable company. Our supply chain will have to adapt, and we will find a new way. Okay, so in the long term, it always comes back to this. Do you make products and technologies that are important to the world? Are you building things with great craft and care that customer deliver and receive benefits? And are you doing something that really impacts the world? And if those things are true, everything else will solve itself.
Nvidia CEO Jensen Huang, they're speaking in Beijing following Washington's about-face when it comes to China chip exports. Let's get more on this and bring our tech correspondent Annabelle Drewlers, who joins us now in Taipei. And it is a win for Nvidia. We don't know how long this will last.
Yeah, that's right. That's really going to be the key question, I think, moving forward. I mean, Jensen Huang has been saying that Washington's assured him that they're going to be moving really fast on granting these licenses to export H20 chips to China. The other question is really going to be as well, how much demand will there be, given that H20 chips, they're not the most advanced on the market in terms of Nvidia's overall products, but how much of companies in China also switched to local alternatives instead. So some of the key questions that have come out of this, of course, before this about turn that we had from Washington, there had been expectations that Nvidia was looking at losses of around $15 billion from this alone over the course of 2025. So certainly something to be really closely tracked. But as we've been discussing, I mean, this has been really the consistent message that Jensen Huang has had for months now, that if you continue to restrict China's advancements in trying to build out its AI capabilities and trying to build out its advanced chip capabilities as well, then you would just continue to drive that need for self-sufficiency or self-reliancy. And so that obviously is played into the calculations. The other thing that's not clear as well, of course, is just how much this was down to Jensen Huang's lobbying in Washington, or how much this is also Washington thinking about the bargaining chips and its negotiations for broader trade wars with China.
Belle, we're going to hear from TSMC reporting earnings later on today. To what degree is the trade and tariff environment going to cast a shadow over these numbers?
I think it's not necessarily going to cast a shadow so much. I think that the numbers are expected to be strong, but I do think it's going to be very closely tracked in the earnings call later today. Just any sort of readout or sense check we get of how TSMC is managing these risks. I mean, yesterday, for instance, we had the reporting that Taiwan does think that it can make a trade deal with the US before the August 1 deadline. So any sort of glints or insights we get on that, of course, we wouldn't expect them to address it directly, but still will be very, very interesting to see. Also, TSMC as a company, are they thinking about accelerating any of their CapEx plans in the US as well, given there's some very favorable tax incentives in place right now? TSMC could get some credits, for instance, if they break ground on new plants in the US by the 2026 deadline. So that'll be also one area to watch, as well as anything they say around the FX headwinds that they've faced, and as well that continued build out to 2-nanometer capacity.
Annabelle Drewlers there. And now let's bring in for some more analysis Alex Capri, who's a senior lecturer at the National University of Singapore's Business School. He's also the author of Techno-Nationalism, previously having served as a trade specialist in the US Treasury Department. Alex, really great to have you with us. First of all, how surprised are you by this turnaround in strategy from the White House?
I'm not surprised at all, because I think we have to look at tariffs in a much, much broader context. And specifically, we have to consider techno-nationalist side of things, right? The tech competition between the United States and China, and the other variables that go into that. So the U.S., of course, and the rest of the world, highly dependent on rare earths, critical minerals from China. China has an insatiable appetite for chips, obviously, as China and the rest of the world go through this AI revolution, if you will. So I think there's quid pro quo here, right? And also I think another angle, looking at this again from a geopolitical and a techno-nationalist standpoint, to create a kind of dependency in China on U.S.-made chips, right, or U.S.-designed chips and American companies, means that perhaps, although I don't believe this is going to be the case, but I think there are those that would believe that this is going to prevent China from forging ahead with their own efforts to become self-sufficient.
So clearly there's an acknowledgement that broad technological denial is not going to work in the long run. How much does China actually benefit from this, particularly when it comes to its burgeoning AI sector?
Hugely, because, again, at the end of the day, China wants to be self-sufficient, wants to have its own ecosystems, not just designing, but also fabricating chips. So, again, as the AI revolution, continues, China is going to have access to these H20 chips. Now, again, these are not the most advanced chips. These are probably second or even third generation behind the most leading edge chips that Nvidia has. However, every bit helps, right? So, these are stepping stones for China. So I think anybody who thinks that this is sort of a return to, one big happy trading family, I think is going to be mistaken.
Alex, how long would it take China to build that type of capacity? We have heard from Benson Huang praising China's AI development. Is it just a matter of time before China does develop something that is either the equivalent or superior to what's on offer from the U.S.?
Well, I think we have to be very clear about making this distinction between advanced chips, which are impossibly hard to make and to catch up in, because of the specialized niches, right? The EUV equipment that goes into that. But I think for legacy chips, which are a very, very important and significant portion of the market, because legacy chips can be designed bespoke for very, very niche industries, autonomous vehicles, medical, communications, et cetera. And those are really, really lucrative big markets. So I think China is going to capture more and more of the legacy chip market. Now, they're still dependent on DUV, deep ultraviolet equipment, which is less sophisticated for the larger chips. They're still dependent on foreign technology to do that. So it's hard to say when they'll reach that point, but eventually they will. I think for the most advanced chips, though, the EUV type equipment and some of the metrology and etching tools made by companies like Applied Materials and Lam and KLA, et cetera, Tokyo Electron, obviously ASML, that's anybody's bet, right? But nonetheless, I think China is going to capture a much, much larger share very quickly of the legacy chip market.
Well, in the meantime, as you say, those more advanced chips remain off limits to China, but to what degree can export controls be circumvented?
Well, look, this is an evolving process, right? So export controls today and in the past, going back to 2019, really when Huawei was placed on the entity list, there continue to be a lot of workarounds, right? And global supply chains tend to be very, very difficult to trace and to track accurately. I think what's going to happen now, and we're in the process of seeing this, is the arrival and the sort of the evolution of a very, very advanced transparency economy, right? As new technologies like quantum dot technology, for example, which is sort of the quantum version of RFID, tracing chips. I think as that kind of technology evolves, companies are going to get more and more transparency and traceability into their global value chains. And that's going to be necessary to determine accurately, whether or not chips are being transshipped, where they're actually going, who the end users are. And so I think as that part of the industry evolves, I do think that it will be easier, and I think BIS, the Bureau of Industry and Security in the United States, under the Department of Commerce, and other agencies will be able to more effectively enforce export controls.
Alex, I wanted to end talking about rare earths, because even though there seems to be some sort of give from Beijing on this in this tentative trade truce, how much compromise is there given how tightly held this aspect has been by China over the past few decades?
This is a very uneasy kind of trade détente. As we speak, efforts are underway to, reshore, nearshore and reshore rare earth supply chains as quickly as possible. So those will continue. So I see a continued and even an accelerated bifurcation of the strategic tech stack, right? So that's everything from rare earths, chips, to cloud and Internet of Things, software, and ultimately AI. Every single one of those elements of the tech stack, I think, is going to continue to bifurcate over the long term, and we're going to see, strategic reshoring and ring fencing taking place. As Jensen Huang mentioned, the global economy is going through a fundamental reorganization. I don't think it's a deglobalization process, but it is a fundamental reorganization. And certainly any of those elements in the tech stack are at play right now.
All right, Alex Capri, Senior Lecturer at NUS Business School. Thanks so much for joining us. Up next, Wall Street banks report record revenue hauls as they reap the benefits of volatile tariff-fueled trading. We'll have the details next. This is Bloomberg.
They've got money in their accounts, they're employed, and the wage growth has been relatively strong, and so they're in pretty good shape. The credit quality is good. They have equity in their homes. They're low rate financing and mortgage, so consumer's pretty good. When you go to small businesses, that's more the question, small, medium-sized businesses.
The second quarter unfolded with two distinct halves. The first half began with uncertainty and market volatility associated with the U.S. trade policy, and the second half ended with increasing engagement and a steady rebound in capital markets.
I want to recognize that despite the resilient global economy and market backdrop, much remains uncertain. Geopolitical concerns have intensified in many regions, most notably in the Middle East. A number of trade agreements have yet to materialize, and that the ultimate impact on growth from higher tariffs is yet unknown.
As U.S. bank CEOs speaking after their bumper second quarter earnings. Goldman Sachs stock traders have posted the largest quarterly revenue haul in Wall Street history, raking in $4.3 billion on volatility sparked by the Trump administration's trade war. Across the top five U.S. banks, first half trading revenues surged by $10 billion year on year. Let's get some more on this now with Bloomberg Intelligence senior analyst Matt Ingram. So Matt, Goldman Sachs CEO David Solomon said the activity driving its equity trading business feels sustainable. Do we need to put an asterisk there, sustainable in the current political environment?
It's a big question, Paul. I could probably dedicate a PhD to it, actually, but it's sustainable until it's not. Markets are expensive, but with cash rates coming down, with the fear of tariffs seemingly somewhat behind markets, investors are buoyant, but we've seen this before. When banks are posting record trading volumes, it doesn't seem to be sustainable forever.
Citi's Jane Fraser saying that volatility is a feature, not a bug, of the new world order. Record trading revenue from peers, of course, that we've seen. What's the read for Asia Pacific?
Volatility is great for banks, Heidi. Clients hate it, and so I guess that's a win-win. Clients get to get rid of the volatility, banks get to make revenue. As David Solomon said, volatility is not going away, and so that's going to continue to create activity in fixed income and FX particularly. When you overlay on top of that those strong equity volumes, it's looking really good for banks. The question for our region, particularly Macquarie here in Australia, it's extremely leveraged to commodities, and we're not seeing that volatility flow through to oil and gas, etc. so far. So Macquarie might do what they've done recently and lag a bit on these trading revenues, but across Asia, HSBC and their peers in North Asia, it looks pretty good for them.
Well, let's talk a little bit about deal making, because US tariffs kind of put that on hold after US banks were expecting a boom following last year's election. So what's the lay of the land now, particularly in the Asia Pacific?
It's an interesting story, Paul. As we spoke about yesterday, JP Morgan actually stepped back in deal activity in Asia, where they had a really strong result globally. When we look at the Asia region, two banks stand out, Nomura and Macquarie. Nomura's up several times this year versus last year, and Macquarie's is double last year. So we should see pretty strong M&A volumes. Overlaying over that the volatility, we should start to see some pretty strong results from those Asian investment banks in the next couple of weeks.
Bloomberg Intelligence senior analyst Matt Ingram, as we get those bank earnings flowing through. And meanwhile, JP Morgan's market value, get this, is now bigger than its three largest rivals combined. The lender posting $30 billion profit in the first half. That's more than twice its nearest competitor. It's also widened its investment banking lead over Goldman and Morgan Stanley. The CEO Jamie Dimon says all its competitors are growing and expanding, and fintech companies also want to take big chunks of JP Morgan's business.
Let's turn back to Asia now. And Japanese stocks could face extended losses after this Sunday's upper house election. Political uncertainty is already dragging the market, with polls suggesting the ruling coalition may lose its majority. Let's get to Tokyo now and our senior stocks reporter Hideyuki Sano. So Hideyuki, how are Japanese stocks reacting to the possibility of the ruling coalition's defeat in the election?
Hi, Paul. As you say, recent polls suggest that there's a real chance of the Liberal Democratic Party-led coalition losing majority in the upper house, and that is putting pressure on Japanese stocks already. And if you look back what happened after ruling parties lose a majority in the upper house, you can, as you can see in the chart, you can clearly see the difference, quite big difference between the cases where ruling party won or lost. Now, if you think about the structure of the Japanese diet, this makes sense because it's the lower house that has a slightly bigger power in terms of choosing the prime minister, etc. But in most other respects, the upper house has an equal power, which means that basically if the ruling party loses an upper house election, it means a weakened government. And so you can expect that political uncertainties to drag on for quite a while, and that's putting pressure on Japanese stock prices at the moment.
Haidi, we've seen potentially a bit of a setback when it comes to these corporate governance reforms. This morning we're just hearing from Couche-Tard abandoning its $46 billion takeover bid for Seven & I. Does depending on what happens in this election potentially have implications when it comes to reform prospects?
Yeah, that is a very good question, and that's not something that people have talked about a lot so far. But if you look at polls, there's a sign that some fringe parties are going to do extremely well, and one of them is openly calling for a change to in what they. In their word, a change to an economy where too much profits flow to shareholders. Now, most analysts think that corporate governance isn't a major policy issue at this point. And even for this small party, that doesn't seem to be a priority at this point. So people don't really expect an immediate change to corporate governance initiatives, but depending on the outcome of the election, you could expect a sort of change in the tone of the debate about corporate governance. So this is clearly something investors will probably need to keep an eye on in the future.
Bloomberg senior stocks reporter Hideyuki Sano there. And we do have some breaking data just crossing the Bloomberg when it comes to the month of June exports and imports. That trade data coming through with the trade balance coming at 153.1 billion yen. The trade balance there is a deficit of 235.5 billion yen. Exports, the year-on-year headline number for June, seeing a contraction of 0.5%, missing expectations of a modest gain of 0.5% and extending the contraction contraction in exports of 1.7% that we saw in May. Imports seeing a gain of just 0.2%, still marginally better than expectations of a contraction of 1.1%. And it does sort of reverse a little bit of that very steep contraction in import numbers of 7.7% in May as well. Of course, also key to this broader picture is the fact that we've still seen a lack of progress when it comes to US-Japan trade talks there. Both sides seem pretty frustrated as that sort of continues to drag on beyond the previous deadline, potentially going into that August deadline there as well. And this also coming as we see the political risk going into the upper house election and some of the debate over a potential Japan rating cut as these fiscal and debt risks continue to rise. We also have Japan's CPI out this Friday as well. More ahead on the Asia trade. This is Bloomberg. Well, we're watching 7&I. We're not really watching it because that stock is suspended from trading so far today. But of course, we saw Couche-Tard now withdrawing its proposal to buy 7&I, this $46 billion acquisition bid, citing just a lack of engagement. It's interesting because we did have some sort of engagement as recently as April, but it has been a very lukewarm process the whole time.
Oh, certainly. I mean, I'm watching 7&I's response to engagement. It's really been non-engagement. It's been like watching a rock. Hasn't it? It's a masterclass on how to say no without saying no. Well, now the focus, I guess, switches to 7&I's restructuring program. We've got a new CEO, of course, is Stephen Dacus. He's going to look to sell the superstore business, a share buyback program as well, a listing of the US business. We'll just have to sit back and see if all of that happens. But as to the next move from Couche-Tard, we'll watch that too.
Exactly. The implications for, the government-led corporate governance efforts as well. This is a bit of a setback, particularly ahead of that upper house election. But we've seen that response from Bloomberg Intelligence saying that this really kind of puts further pressure now for 7&I's management to deliver after this Couche-Tard withdrawal of its takeover bid. We could see sort of further attention on the monetization of the North American businesses, a potential IPO, execution, market timing in the middle of a trade war. All of this becomes very uncertain now. Market opens in Tokyo, Sydney and Seoul are next. This is the Asia trade. We're counting down to Asia's major market opens. We've got some corporate drama, Couche-Tard and 7&I in focus. That stock currently suspended as we head into that Tokyo session. But of course, dropping that $46 billion bid. Lots of drama at the White House, as usual.
Oh, absolutely. I mean, will he be fired? Won't he be fired? Jay Powell must be getting rather tired of this narrative. But President Trump rolling back again the suggestion that he's going to fire Jay Powell. That seems like a pretty lively discussion took place in the White House today.
Questions also whether the markets are going to get tired, right? We saw that bounce with the denial, the sort of sigh of relief, I guess, that there's potentially the chance that we'll see further consistency, at least for a few more months from the Federal Reserve. But let's take a look at what we're expecting to be really a pretty mixed open going into the start of trading across Australia, Japan, as well as Korea. The Nikkei 225, a pretty slow start there. Of course, we are expecting a lot of sideways to negative trading as we get into this weekend's upper house election and all of the political as well as fiscal risks there. There is a projection that potentially the ruling majority, the ruling coalition, I should say, would lose their majority. The implications for policy. At a time we're seeing a lot of broader uncertainty, including a lack of resolution when it comes to trade and the tariff deal between the US and Japan still on the table there as well. The topic's also softer by just about 0.2%. Dollar yen, this is how we're looking. 148 is the picture. A lot of question marks in terms of the longer term direction of the dollar, even as we've seen a little bit more of a rebound. And of course, the concerns over the longer end of JGBs continues to play out given the debt and fiscal concerns going into that election. Take a look at what we're watching when it comes to Korean stocks at the moment with the KOSPI and the KOSDAQ also coming online. A bit of upside, 0.4%. We're still seeing some of that sort of positive sentiment with the reversal of the White House's broad technological denial strategy with China, with the potential opening up of some more opportunities for these Nvidia and AMD exports. But we're also looking at the potential to drive the cost be a little bit higher, with South Korea looking at a policy to redirect household wealth concentrated in real estate, Paul, going into equities.
Well, we've just opened for trade here in Australia as well, off to a reasonably bright start this Thursday morning, up by about 0.4%. We do have the staggered open, so later on, one of the stocks we're going to be watching is Santos. We've just heard from the oil and gas producer narrowing its production forecast for the full year to between 90 and 95 million barrels of oil equivalent. So a slight reduction in the production forecast coming from Santos. So we'll watch that stock a little bit later on. And on the topic of oil, it has pulled back a little, edging a bit lower on oversupplies. Stockpiles start to grow. Take a look at what's happening in yields, though. Got the two-year yield just nudging up. We did see it slip 5 basis points during the US session. We've got the 10-year at 446.53 as well. The reason for that? Well, it's that old story again. The future of Jay Powell. Let's hear the latest from President Trump.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned.
Well, let's bring up Bloomberg News Desk editor Jill Deesa. Says never a moment of dullness or certainty when it comes to policy making and projections from the White House, right? Is this sort of another indication of the flexibility of what the president might be thinking, a la the taco trade that the markets have gotten very comfortable with?
Yeah, I mean, look, Haidi, first of all, I mean, this is, in some sense, Trump has been floating this idea of whether he has the power to dismiss Powell or not for months. We know that he's really dissatisfied with the pace at which interest rates are being cut. So this is, clearly something that continues to vex Trump. I mean, the latest that we've heard is essentially that, he had a meeting with several lawmakers and that some of those lawmakers left this meeting with the impression that Trump was ultimately floating the idea of whether or not he could fire Powell. I mean, we heard in this same meeting in the Oval Office just now, while he did, while he's saying that he's denied it or that, he doesn't have any plans, he did later on say, I think it's highly unlikely unless he has to leave for fraud. That's the direct quote from Donald Trump. And so that kind of ties into this idea that has caught fire with at least some Republicans, this idea that potentially Powell could be dismissed over some renovations that are being done at the Federal Reserve headquarters. It's something that Powell himself has said that, there's doesn't really see an issue there, that he's invited an independent investigation. But you do kind of see it in that extent that it could be that Trump is floating some kind of a trial balloon here for, what are the mechanisms by which, he could make Powell leave before, the next, 10 months or so when Trump has the right to appoint a new Fed chair. Anyway, obviously this does raise a lot of questions about the independence of the Fed, about what kind of mechanisms could be at play here, what kind of, legal scenarios we're dealing with. But I think, as we're kind of seeing from the market reaction, Haidi, I mean, if this is a trial balloon, we did see some declines in stocks and short-term yields. So there's a little bit of volatility there, but it wasn't, a giant repricing or anything like that before Trump ultimately came out and made that denial statement. So, I mean, if you're Trump and you're seeing that as a trial balloon, I do have to wonder whether or not that kind of emboldens Trump in a way.
Well, Jay Powell is a Trump appointee, and I mean, when his term expires next year, President Trump will get to appoint a new Fed chair, but who's to say that the next Trump appointee is going to be any more compliant than the current one?
Yeah, I mean, look, Paul, there's, several names have been floated for that potential position, among them Kevin Hassett, leading the economic council. I think that the question, yes, is, whether or not you actually bring someone in. Yes, you're seeing a list of potential Fed contenders right on your screen there. The question is, whether anybody appointed to that position is ultimately going to sort of manage the Fed in a way that, Trump ultimately desires. As you mentioned, Paul, look, yes, I mean, Trump appointed him in his first term. I think you just heard in that clip, he's trying to kind of shift it a bit and say, oh, well, he didn't think that Biden should have reappointed Powell. But, again, it's really not that long. It's less than a year before Trump ultimately has the ability to appoint a new Fed chief. I think that the fact that, you do see him getting riled up at this point, potentially musing about a firing, even again, if now he's saying that he's not planning it or he's, denying it in some way, it does kind of indicate that this, again, is something that just continues to really, really bother sure. Donald Trump, I'm not sure, where we go from here. But again, I think removing Powell in any way does raise a lot of pretty serious questions, and we'll have to see whether or not that's enough to kind of jolt the market more. But it's really, really tough to say at this point.
All right, Bloomberg's Jill Desis there. Let's bring in George Boubouras now. He's Managing Director at K2 Asset Management. George, thanks as always for joining us. And I do want to start on this debate around the future of Jay Powell. I mean, it is all just rhetoric for now. Considering that, does it prompt you to change any allocations or make any decisions?
Good morning. Good to be with you. Prompt us to do absolutely nothing at all. It is noise. We call it theatre and noise to amplify that it's all about the politics of every institution in the US and every other democracy. There's a nuance to it. There's always been politics. Politics is a blood sport. This one's a bit more overt, and you adjust it for President Trump and his language. And I think the market's falling into this discussion and trap and headlines of will he, won't he. But taking a step back is that there's a term to be fulfilled, and Powell will obviously transition out next year. The new one will be announced sooner rather than later. And the markets would get along with that because the Federal Reserve as an institution has always been focused on price stability and that full employment and that delicate nature. There is that independence that will survive. It's not going to be an existential threat to the bond market and the sovereignty. It's just going to be more politics. It's going to amp up a little bit more the language. The White House would take it up a notch. But if I can just a bit tongue-in-cheek, there's a consistency with the White House that if someone doesn't agree with an institution, they want to move them on. And that's like everyone in the White House. It's just someone more overt. And at the end of the day, before the president in a former life was a property investor and developer, and core to their heart, I'm sure he would like a lower rates right across the curve as a property developer in the former life. And that's a little bit tongue-in-cheek. But at the end of the day, we think that it's going to be more language that's going to be amplified, but nothing to see here because the Federal Reserve has made it very clear that they want to keep the discount rate higher this stage of the cycle and the cycle ahead versus the previous cycle. That creates more price stability and removes excesses if you go overtly low with cash rates like they did in the previous cycle. So we think it's the wait and see is a little bit different to the ECB, which has been aggressive in its rate cut cycle, but it seems pragmatic for now. And the new head of the Federal Reserve would no doubt reinforce that the cash rate cycle won't be as low as the previous cycle. And again, high discount rates across the curve, that's the way to look at it for the cycle ahead.
Yeah, well, of course, to your point, the chair of the Federal Reserve is just one voice in a room full of voices. But more presently, we do have a Fed meeting coming up at the end of the month. The smart money seems to be saying that it's going to be yet another hold, certainly likely to fuel a few more attacks from President Trump. But even if it is a hold, I mean, time's running out now for 2 cuts this year. What's your view?
Yes, time is running out for 2 cuts this year, so we've adjusted. We're going from September to July next year. We're going for 3 rate cuts in our modelling in that scenario, and you are right, time is running out. You'd have to think that nothing's changed from the previous Fed meeting to say overtly that they need to start cutting sooner rather than later on their narrative. If it was the ECB, they would have cut. Different nature there, but because the Federal Reserve are going to they're making it very clear. They're looking at the hard data. They did look at the sentiment data, but it's a low correlation to the sentiment data at the household and the business level. It hasn't correlated into very weak data in the imminent sense. But let's just see how we're getting to the other side of these trade, transition and tensions and what's going to happen with the hard data. But so far, core inflation is broadly behaving, and the hard data, we're just seeing it a little bit weaker. But I would put more of this weakness at the late stage of the cycle as opposed to the tariff. So we have to wait and see approach. Going back to the Fed's narrative, why not wait until September, which puts a lot of heat on, obviously politically.
We saw the Treasury reaction to the sort of Powell latest developments, right? But broadly, we also have seen that steepening as well as the concerns building on the longer end of the curve. Does that tell you about a potential worry that we're going to get a more hawkish than expected Fed? And how does it build into really the global trend that we've seen in longer dated yields?
Yeah, I'm sympathetic to that question, Heidi. A hawkish Fed seems to be what we think will come in play. And also, again, going back to my previous comment, high discount rates going forward. Having said that, the 210s is obviously the most liquid part of the yield curve anywhere in the world. It's where all the financial engineering is aligned to the 210s. And that steepness, as you suggested, it says a number of different things. That steepness, reference on the swap steepness as well, is broadly indicative as a tailwind for net interest margins for US financials. We like US financials. So we think that's going to continue, and that steepness. Again, people talk about the bond auctions and global demand. We think that's a bit of a noise. We think that international players are at the bond auctions, they're playing and they're participating. And I do think that steepness and that hawkish nature of the Federal Reserve would persist, but it's more that 210 steepness. So cash 10 steepness won't be as steep as people think, or the 90-day, but that 210 will be steep enough where the financial engineering reinforcing with everything's priced off that, and we believe that will be the norm more than not over the next 18 months.
Outside of the US, what are you looking at? Perhaps more opportunities out of China, given that with this tentative truce, the data seems to be holding up okay. Are you constructive on Europe, as so many people continue to be?
Not quite constructive on Europe, but we like the re-rating. There's a bit more re-rating in the equity market in Europe. Obviously, valuations are a little bit more expensive than 3 months ago, but much more cheaper than the US. We're not value. We don't believe in value. We're growth at reasonable price where we can, or absolute return. But nevertheless, there is some more re-rating to squeeze out of the EU. The Hang Seng has been quite volatile, so it's obviously a derivative of mainland China. Mainland China still, the weakness is quite extreme. Still the export sector that's been subsidised, one of the best in the world, and continue to be so. And there's some good prints coming through on the national accounts for the X-M component of China. But very quickly, we do, despite the absolute tectonic change of deflation, migration to inflation or prices picking up in Japan, we do, once we get to the other side of this and the shifts, which is quite disturbing for their economy, we believe Japan would be a good place to be for calendar 26 and beyond at all parts of the capital structure. But they're going through a lot of changes, and there was also some political issues going on there as well. At the moment, there's quite a bit of a nuance there. But Japan for 2026. And then very quickly, Heidi, we do like senior unsecured rated bonds and developed market equities versus EM at this stage going forward from a tactical tilt.
All right, George Boubouras, Managing Director at K2 Asset Management. Thanks, as always, for joining us. We have more ahead on the Asia Trade. This is Bloomberg.
We're very close to India.
Wow.
And we're very close to, we could possibly make a deal with the EU.
All right, President Trump there speaking on tariff negotiations in a radio interview, saying he could possibly make a deal with the European Union, although earlier comments, President Trump said he is also indifferent to a trade deal on the EU. So with that piece of information in mind, here's a look at how European futures are trading. A little bit of positivity there for Euro Stoxx 50 futures and DAX futures as well. And we're seeing the euro losing some ground against the US dollar, which has shown a little bit of strength of late. All right, sources within the White House, meanwhile, saying President Trump has softened his tone with China to secure a summit with Xi Jinping and a trade deal with Beijing. Let's bring in our Chief North Asia correspondent, Stephen Engel in Hong Kong. So, Steve, what more do we know?
Well, this is an interesting story that we've sort of seen play out over the last week. Case in point was that Nvidia H20 chip deal. I'll get to that in a little bit. But essentially, sources inside the White House are essentially saying that when China comes up in the inner circle, usually Trump is the most dovish of the bunch. And essentially, he wants to soften his tone as we approach that August 12th trade truce deadline. deadline. All indications are that the White House is looking at possibly extending that, possibly for another 90 days. But the ultimate prize, I think, for Donald Trump, according to these sources, is a summit with Xi Jinping, a very high-profile summit, obviously, wherever it might be, and he wants a trade deal, not just a truce. Remember, way back in April, they basically said they wanted 90 deals over 90 days. They've had maybe one or two and a truce, and that's about it. So again, the clock is ticking on all these other nations as well that are lined up. And as a side note, Donald Trump essentially saying that they're going to be sending out letters to some 150 countries outlining the deals that are going to be made. But with China is the ultimate prize here. And these sources are telling us that he's really focusing more on cutting purchase deals with China, like what he struck in the first term, in the first trade deal with China, and celebrating quick wins instead of addressing the root causes of the trade imbalances. Of course, he was quite hawkish against China on the campaign trail, and others within his cabinet have been very hawkish as it relates to the trade restrictions and export controls. But he's pulled back a little bit as negotiations get down to what can I give and what can China reciprocate. The ultimate prize, obviously, is to get a quicker export licensing process from China on rare earths and rare earth magnets, and maybe that's why that chip concession earlier this week or late last week, whenever that was made, the tacit approval to Nvidia was made, was part of that equation. But right now, the ultimate goal is to get that summit. China's not really blinking right now or giving any indication that it will or will not happen, even though Marco Rubio, the Secretary of State, says he's more encouraged after his meetings Friday with Huang, his counterpart in Beijing.
How do we read the reversal when it comes to the H20 chips from Nvidia? Is this another sort of signal of a softening stance towards Beijing?
Well, I think it was quite telling that it wasn't the White House that announced that Nvidia would be able to apply for the licenses again, and that essentially there was tacit approval for the approval of those licenses, and that Nvidia could then resume shipments of these watered-down AI accelerators, which, of course, were added to Trump's export controls in April. And then Nvidia was busy making its own next compliant chip based on the Blackwell architecture that was essentially going to be completed around September. But now, with the H20 back in the fold, it makes things very interesting. Obviously, it was a big win for Jensen Huang, as he's been lobbying the White House, saying that these export controls on these advanced chips are doing more harm to America's tech companies than good, and giving unfair advantage to the likes of Huawei and the domestic chip industry. So that backpedaling, if you will, perhaps is an example of the softening of the tone by Donald Trump, much to the chagrin of the hardliners within the Trump administration, which would like and have repeatedly said, I'm not saying Scott Bessent is a hardliner, but Scott Bessent, even a few weeks ago, indicated that these chip controls are an indication that there is no negotiation, or there is a tougher stance on China when it comes to those exports of advanced semiconductors. So again, there's some mixed signals right now, a softening of that tone, though, from the sources inside the White House, because Trump wants a deal. He wants a quick deal, and he wants a summit with Xi.
Chief North Asia correspondent Div Van Engel there with the latest. And more ahead on the Asia trade, this is Bloomberg.
Right, we're waiting to hear from Seven & i after its deal with Couche-Tard, that $43 billion takeover offer, ended rather damply. Couche-Tard walking away, accusing Seven & i of not engaging. Seven & i responding now, saying the Couche-Tard statement has many incorrect assertions and that Couche-Tard has ended its one-sided approach. So some pushback there from Seven & i on Couche-Tard's narrative as to why that fell over. Seven & i shares not trading at the moment in Tokyo, Heidi.
Yeah, interesting response, given the Couche-Tard statement actually had some very interesting details in terms of what they saw as a complete lack of engagement from the other side. But in the meantime, we're also watching bank earnings, of course. Goldman stock traders have posted the largest revenue haul in Wall Street history. $4.3 billion on volatility sparked by the Trump administration's trade war. So across the top 5 US banks now, first half trading revenue surged by $10 billion year over year. Let's bring in our Bloomberg Intelligence senior analyst Matt Ingram. So, volatility as a feature, not a bug of the new world order, is what we heard from Jane Fraser. Certainly the banks are benefiting.
The banks are definitely benefiting, and it's kind of banks win, clients win. Clients hate volatility, as you know. The more we see uncertainty around tariffs, the more we see interest rates up and down, the more we see central banks back and forth on will they cut, won't they cut. Banks love it, and clients need to hedge that risk. I mean, we've even seen some of the banks themselves hedging that risk. HSBC massively reduced its risk to interest rates last year. So even the banks themselves are gaining both ways in that trend, and it looks like it's going to continue. We're still seeing a lot of noise around tariffs.
Yeah, well, Goldman Sachs CEO David Solomon said that, the volatility driving its equity trading, feels sustainable. What are your views?
Oh, look, we've said Goldman set the gold standard in equities, but when a CEO stands up and says record trading revenues are sustainable, as a banks analyst who's looked at the sector for a long time, I'm sceptical. Goldman said a year ago that they were going to focus more on clients, and clearly that's flowing through. They've also said they've got a very strong pipeline. So I guess watch this space. There's a lot of things in Goldman's favour, and it's not just equities that are driving these record hauls, fixed income, FX. The one notable standout is commodities that's probably lagging a bit, but Goldman has a lot of tailwinds.
Bloomberg Intelligence senior analyst Matt Ingram there on the banking earnings. And just to get another look at what we're hearing from Seven & I at the moment, really responding to that Couche-Tard statement that they're abandoning the $46 billion takeover bid on account of a lack of engagement from Seven & I management. At the moment, Seven & I saying that the Couche-Tard statement has many incorrect assertions, that they'll continue efforts to quickly improve performance, which is going to be key given that Bloomberg Intelligence pointing out that this falling apart of this deal, sort of the fading prospects of this coming together, means that there's going to be further pressure on Seven & I management, which have been given something of a grace period from shareholders to make some of these reforms and changes. A lot of attention will be on the monetization plans for the North American businesses, what sort of operational strategic possibilities are available there, potentially the likes of some bolt-on M&A deals. This is Bloomberg. We do have some comments just coming through from the Fed New York President John Williams. In amongst them, he talks about the restrictive stance being entirely appropriate. He does expect tariffs to have a bigger impact on inflation in the coming months ahead. Still have a ways to go to reach that 2% inflation target. There are factors also supporting the strength of the dollar that are still in place there. Williams talking about more investors hedging their exposure to the dollar, and they're not seeing a move away from dollar-based assets. Also reiterating that central bank independence is very important. This, of course, comes in the backdrop of the ongoing kind of to and fro skirmish between President Trump and Fed Chair Jerome Powell. The latest being, of course, President Trump denying that he's seeking to remove Chair Powell from his role, saying, no, we're not planning on doing anything, that he doesn't rule out anything, but that he thinks it is highly unlikely that that could happen. We had heard from the White House, some lawmakers, that they expected Trump to move against Powell after a meeting to discuss cryptocurrency legislation, but these latest remarks, of course, making it very much uncertain. And we're hearing that reiteration of central bank independence as being very important from the New York Fed President John Williams in these latest remarks, Paul.
And we've got some breaking data out of Singapore as well. It's June non-oil exports, a big beat here, rising 13% on year. The expectation was for just 5%. Electronics exports performing quite strongly, rising 8% on year as well. If we take a look also at June at non-electronics exports, we saw an increase of 14.5% on year also. So pretty good set of numbers for the non-oil exports out of Singapore. Just to recap, a rise of 13%, decent rebound from the month of May. Let's take a look at how markets in Asia are tracking as well. We are seeing somewhat of a mixed picture at the moment. Some modest gains here in Australia. We're better by about 0.5%, but elsewhere some declines. The Nikkei off by 0.4%, a little bit of softness for the Kospi as well. And of course, we've seen some upheaval in markets, Haidi, due to the latest round of will he or won't he fire Jay Powell. I'm talking about President Trump, of course.
And of course, this also comes amidst ongoing uncertainty when it comes to the broader kind of trade and tech strategy out of the White House. Nvidia chief Jensen Huang says he hopes to get the first batch of renewed US licenses soon to export these H20 AI chips to China. Speaking in Beijing, he told us that the now lifted US ban on these chips will cost the company, but it's willing to adapt to any changes in the trading landscape.
Some of the things that we wrote off might be harder to recover, but most of the things that we put on reserve will not be scrapped permanently, was not scrapped permanently. And so we'll compare what customers would like to buy now versus the inventory that we have, and then we can figure that out. It's probably not 100%, but it's not 0% either. Tariffs. You know, the world is reconfiguring itself, and we are a company, and we have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into Nvidia. There will be trade, tariffs, and taxes after I leave Nvidia. And so this is something we all have to adapt to. But the very incredible thing is, Nvidia is a very adaptable company. Our supply chain will have to adapt, and we will find a new way. Okay, so in the long term, it always comes back to this. Do you make products and technologies that are important to the world? Are you building things with great craft and care that customer deliver and receive benefits? And are you doing something that really impacts the world? And if those things are true, everything else will solve itself.
Nvidia CEO Jensen Huang there. Let's get some more when it comes to the outlook for global chips and the supply chain. Emily Benson is the head of strategy at Minerva Technology Futures. She was a senior advisor at the US Department of Commerce during the Biden administration. Emily, let me first off get your views on seemingly this sort of policy about face from the Trump administration. Clearly, they view the policy of broad technological denial to China as something that they don't think will work. What do you make of this turnaround?
Well, thank you for having me. There are certainly two main dynamics at play here. One, of course, is the ongoing bid by the American administration to conclude a trade deal with Beijing. There are rumors that a deal could potentially be concluded in August. I think what's more likely is a mid-fall timeframe. That puts a lot of pressure on the United States to make concessions in the meantime to free up rare earth exports from China in order to gain additional certainty over supply chains. The other dynamic, of course, that is looming larger over these discussions is the increasing recognition that a lack of U.S. exports to China in advanced tech could be filled by Chinese equivalents. And here we're talking about Huawei products.
Because to be fair, a licensing change doesn't necessarily reflect a fundamental shift in the strategy. And I guess even if there is a fundamental shift in the strategy, we know from this administration that that could all change at a moment's notice too.
I do think that's worth noting. There's been a lot of discussion today in Washington, certainly around town, about to what degree this does denote a fundamental shift in Washington's policy. As you note, this is a licensing change. It doesn't only affect Nvidia, it also includes AMD products to China. I do think, however, there is a broad recognition that when the U.S. fails to allow certain exports for which there is a solid foreign alternative of a like product, that that failure to allow that export results in market share loss for U.S. firms. And it's increasingly evident that the U.S. is keen to provide a supply that would allow the continued domination of a certain marketplace, especially with a strategic competitor.
To what degree does this feel like a truce of convenience for you? I mean, China's going to get access to some of the chips that it wishes to get access to. The US appears to be getting a hold of those rare earth magnets and products that it was not able to get. Once those supply chain issues are worked out on each side, how long do you think this truce has got to last?
That's a fantastic question, and of course this is coming on the heels of a discussion that occurred in London in mid-June between high-ranking officials from China and the United States. It does seem like the H20 chip was included as leverage in those negotiations. What this denotes is that each side is bringing something unique to the table that's been a long-time feature of economic policymaking in respective jurisdictions. It's convenient for both sides, of course, but what this needs to include is a more nuanced discussion of just how far China's own capabilities have grown in recent years. And they could certainly meet some degree of parity with US AI capabilities, but it would require more chips operating at a reduced efficiency rate. And that, again, is something that Washington is increasingly coming to recognize in recent months.
Of course, China's still unable to acquire the most advanced chips that exist. To what degree, though, are those export restrictions watertight?
I do think that there's a certain red line that the administration would have a politically challenging time crossing. This, of course, relates to the H100 and H200 chips. The H20 chip was not controlled until the spring here in Washington, and we've seen this dynamic play out in other domains, including on EDA software, where Washington was very keen to levy additional controls, only to use those as leverage in negotiations. And what we see is essentially a return to the status quo ante. And that is certainly a dynamic that I will be watching in the coming months to see if there are new controls levied, and then the degree to which those are used as leverage and then renegotiated moving forward.
All right, Emily Benson, Head of Strategy at Minerva Technology Futures. Thanks so much for joining us. Let's get back to one of the other developing stories of the day, and that is Seven & I and Couche-Tard, that long-running soap opera coming to what appears to be an end. Couche-Tard abandoning its $46 billion bid to buy Seven & I, claiming, well, there was really a lack of engagement on the part of Seven & I. Not long after that, we heard from Seven & I saying, well, that statement by Couche-Tard has many incorrect assertions. It says Couche-Tard ended what it called a one-sided approach. Seven & I saying it's now going to focus its efforts on improving its performance and pursuing its own initiatives. Let's bring in senior editor now. Reed Stevenson joins us from Tokyo, who's been following this story from the get-go. Reed, what are we to make of today's developments? Where does this leave this deal now? Is it completely dead in the water?
Yeah, for the moment, it looks like Couche-Tard is perfectly willing to walk away. I mean, if you go through the letter, which has quite a lot of detail, they explain their rationale. They go through, their attempts to engage with Seven & I, and they build sort of a convincing picture of, why they don't think a deal is going to go forward without further cooperation from the Japanese operator of 7-Eleven stores. So yes, for now things are on hold, and obviously from the tone of the response from Seven & I, they clearly don't seem to be willing to sit back at the table, or any table for that matter. Really now the focus is going to shift to the shares. At the moment they're not being traded because there are more sell orders than buy orders. So that suggests, we're going to see a pretty steep fall. The stock is already down, 11 or 12% so far this year. And so really, it's going to come down to the investors. Are they going to, buy Seven & I's turnaround and growth story under a new CEO, or are they even going to come out and try and pressure the company to re-engage?
Yeah, how much sort of patience is left in that grace period that it was extended by shareholders, right? Does this really amp up the pressure that management now has to deliver on the alternative scenarios?
Yeah, in fact, they are due to give an update next month on the progress of their turnaround plans, which, involve the sale of a less profitable retail business, share buyback, IPO of the U.S. business, and a growth plan for the core convenience store business, which has not been doing that well in the main markets of Japan and North America. And so really, the pressure is on for Seven & i's management, and all eyes are going to be on them when they go back to investors next month.
Reid, to what degree was this perhaps maybe a cultural issue? I mean, we've got Couche-Tard accusing Seven & i of obfuscation and delay, a calculated campaign of that. Or was it just that Japan's corporate environment is still heavily protected?
Yeah, there's several ways to look at this. For Japan's corporate governance has been changing. It's created an environment where, audacious moves such as Couche-Tard's unsolicited friendly offer would have been unthinkable a few years ago. So in that sense, the fact that this is even being talked about, I think, is progress. But on the other hand, obviously, the resistance to being taken over runs very deep. It's Seven & i does have a very successful convenience store business, which they have built over the years, and they are afraid, or at least the management is afraid, that foreign ownership might really endanger that. For the broader environment, I think what we're going to see is probably, more attempts at deals like this, and at some point one will break through, but maybe this one wasn't the one to be that test case.
I guess we'll know more by the strategy update in August, but what are the options that are available both for the Japan and North American businesses? IPO, potentially, for North America as well, some other forms of bolt-on M&A deals. Are they sort of now more on the table?
Yeah, so the U.S. business is indeed slated for an IPO. Seven & i does have a rationale for that, but it has sort of less to do with, I think, operational issues rather than sort of just streamlining the broader holdings company structure. In terms of bolt-on acquisitions, in fact, many convenience store operators just do them kind of constantly, picking up stores here and there. It's worth noting, though, that Seven & i's own deal making in terms of expanding its empire hasn't gone that well. They bought Speedway from Marathon Petroleum about 4 or 5 years ago, and that hasn't really been reflected in the stock price. But yeah, I think even for Couche-Tard as well, they're going to continue to do deals and show that they've got potential for expansion.
Reid Stephenson, our Bloomberg senior editor there, as we continue to watch these developments now that we've heard back from Seven & i, really contesting some of the statements being made by Couche-Tard in its decision to abandon that $46 billion acquisition bid. More ahead on the Asia trade. This is Bloomberg.
This is the Asia Trade. U.S. Secretary of State Marco Rubio says Israel and Syria have agreed to stop the violence that's killed over 300 people in recent days. Israeli forces struck Syrian military headquarters in Damascus on Wednesday and moved extra troops to the border. Israeli officials say the action is to protect the Syrian Druze community after deadly fighting between Druze and Bedouin groups and Syrian troops. Let's take a look at how some of these key commodities are tracking in the meantime. We've got Brent gaining a little. We did see oil edging a bit lower earlier on oversupply, stockpiles growing. It's not just Syria that's experiencing some unrest. Multiple fields in Kurdistan and northern Iraq were tracked by drones. No one's claiming responsibility for that. 200,000 barrels of production lost, but Kurdistan's been unable to export for a couple of years anyway. Iron ore prices holding on above $100 per tonne, but not a lot of optimism optimism that's going to last, Heidi.
No, and there are a lot of cross currents at the moment when it comes to, of course, global trade, and a lot of uncertainty with the unresolved trade deal still on the table. We heard from President Trump saying that he's sort of almost sanguine in terms of the urgency of getting a deal with the EU. Take a look at S&P futures at the moment, about 0.1%. President Trump saying that he'll send more tariff letters, but of course we had that bounce back with something of relief when he refuted these plans to potentially fire Fed Chair Powell there. The dollar is holding onto some of those gains, but certainly a whipsawed session on the plans for the Fed, both affecting FX, the dollar, and treasuries as well. Well, Bank of America CEO Brian Moynihan is stressing the importance of an independent Fed as a long-running rift between President Trump and central bank chair Jerome Powell intensified. Speaking to Bloomberg, he also talked about his company's second quarter earnings beat.
This quarter was the trickiest quarter to get through because year over year we finally got some NII growth, but year over year the markets business doing strong, so expense growth was a little more robust. That'll get in line, and then you'll see NII drop to the bottom line, and it will set up for 2026 with even more growth.
When you talk about 2026, one of the things we're going to have is, in all likelihood, a new Fed chair. There's been a lot of talk, even today in Washington, about the Fed chair, and you've said you believe in an independent Fed. But if, in fact, President Trump gets his wish, as is his right under law, to appoint a new chair who will be more in line with his views. He said he thinks the interest rate really should be at 1% or even below that. Is that good for Bank of America? Is that good for the economy?
Well, let me make two things. One is, you're absolutely right. In May of next year, the term of the current Fed chair ends after being reappointed, and it's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency, and they're meant to be outside the purview of the executive and the Congress. They are called to task, and they're monitored, and they're reviewed, and all the things. But the reality was set up to be independent, so that our central bank in America was independent. So I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision, because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly. On the other hand, if you think the prior Fed has been slow to lower rates, you might lower them faster. Our team believes that the Fed will lower rates in the second half of next year by 100 basis points. No change until then, because inflation is still going through the system. That brings the Fed funds rate down closer to 3, which they think is probably more of a long-term rate, and frankly is more similar to what we had for most of American history. What's been unusual is the period after the global financial crisis, a very low interest rate structure. That is really not a good place to be, honestly. We'd rather have a higher interest rate structure, a little more inflation, a little more robust economic growth. So I think everybody has to be a little careful about keeping that engine going.
That's Bank of America CEO Brian Moynihan speaking with Bloomberg's David Weston. More ahead on the Asia trade. This is Bloomberg. Bloomberg has learned that embattled Hong Kong developer New World is seeking to sell its flagship 11 Skies airport mall to boost liquidity. Let's get over to Hong Kong and our China correspondent Min Min Lo for more on this. So Min Min, this is really underscoring the cash crunch New World is facing, right?
Yes, New World might be forced to sell at a loss because they invested about 20 billion Hong Kong dollars in the property, but now valuations are discounted at between 15 to 17 billion dollars, and that's because New World has been struggling to sign on tenants. Given the uncertain footfall, it's still not clear how many airlines are willing to relocate their operations to this second terminal that is located next to that complex. And this is coming as New World had missed their internal deadline last week to secure a $2 billion loan, so they might be using the proceeds from this sale to repay debt to their creditors. And it's also coming as we know the firm has been trying to accelerate their asset sales in mainland China as well. The company has about 50 billion Hong Kong dollars worth of completed investment properties in China, but sales again has been pretty slow given the property crisis and the economic conditions in China as well. But you look at Hong Kong as well, financing conditions have been tightening because we have seen, for example, property prices now down to a 9-year low. So lenders are now a little bit more stringent as well about the terms of refinancing in Hong Kong.
Of course, it's not just New World. Broadly, commercial real estate is not doing too well. So is there a spillover risk into a broader banking crisis?
Yes, the concern is there because you look at the level of bad debt that Hong Kong has now. It's now close to a 2-decade high. It's hovering around 2% when just a few years ago it was under 1%. And so much so that some banks are now starting to speak to advisors about potentially setting up a special vehicle to take on these bad debt. Of course, this is according to sources. It's not clear how much traction that proposal will be received by the regulators and by other banks. But a big source of that deterioration of asset quality is coming from the real estate sector. Hong Kong just managed to avert a deeper crisis last week after intense negotiations among a group of banks to give out a record $11 billion loan to New World. And we understand from sources that some banks are under pressure to offload some of their loans that are backed by real estate because we have been seeing, for example, office vacancies up to a record high, valuations for properties down by 50% over the last few years. Of course, the book value, though, on some of these banks' books are not declining as much because the transactions have been few and far between, and some banks might be incentivized to delay any recognition of impairment because that will have implications on the valuations of other property and collateral as well. But for now, the impact is that these banks might be tightening their risk scoring requirements. It might slow loan growth, which would be a drag on economic growth. But for now, the Hong Kong Monetary Authority is also saying that the level of bad debt is still manageable and that the liquidity coverage ratio is still more than sufficient for most banks in Hong Kong.
Bloomberg's China correspondent Min Lo there with one of the sectors we'll be watching as Greater China comes online for trading in the next half hour or so. This is Bloomberg.